Japan's government bond yields have hit their highest level in roughly 30 years, and the ripple effects are being felt far beyond Tokyo. Japanese authorities took the unusual step this week of publicly reaffirming the independence of the Bank of Japan. That kind of statement does not happen without reason. It signals that policymakers are watching bond markets closely and want to make clear that the central bank, not politicians, is driving monetary policy decisions. Here is the backdrop. For years, the Bank of Japan held interest rates near zero and actively capped long-term government bond yields through a policy called yield curve control. The idea was to keep borrowing costs low and support an economy that had struggled with weak growth and low inflation for decades. That policy is now unwinding. As the Bank of Japan has stepped back, markets have repriced Japanese debt sharply, pushing longer-term yields to levels not seen since the mid-1990s. When bond yields rise, it means the price of those bonds is falling. Investors are demanding more compensation to hold Japanese government debt. For a country that carries one of the largest public debt loads in the developed world, higher borrowing costs matter. The faster yields rise, the more pressure builds on government finances. That is why the independence question is so sensitive. Central bank credibility rests on one core belief: that interest rate decisions are driven by economic conditions, not by a government's desire to keep its own borrowing cheap. If markets start to doubt that, they can demand even higher yields as a risk premium. The government's public endorsement of Bank of Japan independence is in part an attempt to head that dynamic off. The global stakes here are significant. Japan has spent decades exporting capital. Japanese investors hold large positions in bonds and other assets around the world, including in the United States and Europe. If domestic yields keep rising and become more attractive relative to foreign assets, some of that capital could flow back home. That kind of shift, even if gradual, can move markets in other countries. The Bank of Japan is threading a needle. It needs to normalize policy after years of extraordinary stimulus, but it cannot afford to let yields rise so fast that it strains government finances or triggers wider instability. Investors will be watching every signal from the Bank of Japan in the weeks ahead. Any guidance on how quickly officials intend to let yields move higher, and whether the central bank is prepared to step in if the move becomes disorderly. The practical takeaway: developments in the Japanese bond market are not just a local story. They are worth tracking as a leading indicator of potential capital flows that could affect bond yields and asset prices in markets well outside Japan. This briefing is brought to you by First Financial News. Clear daily coverage of the economy and markets at firstfinancialnews.com.